Hello, everyone. Thank you for attending our webinar for today. I want to give a big thank you to Howard and Howard for participating and leading this for us. Tom Kessel, who some of you may know, recently started with us and connected the two firms, and it's a very timely matter for a lot of people. And so we brought in some of the best and brightest to help us out. Just a quick housekeeping item. We're going to reserve all questions for the end of the webinar. So please, if you have a question, use the question and answer box at the bottom, and we will try to get to as many of the questions as we can. And so, Andy, if you want to kick it off, and we'll go from there.
Right. Thanks, Matt. Thank you all for listening in today. While I wish it could be under better circumstances, I think it's critical that everyone, and especially if you're a business owner, understand the incentives and relief provisions brought about by the new CARES Act. Telemus's core mission is helping people make smart decisions with their money. And the best way to do that is via planning, educating, strategizing, and implementing a thought-out plan. And in that regard, as Matt indicated, we are teaming today with the legal, tax, business, and HR experts at the law firm of Howard and Howard. But before I let them start their program, I wanted to share some critical observations. First, this new over 800-page law was negotiated, drafted, and approved in a historically short period of time. As a result of the quick turnaround, there are many questions and issues that are unanswered and that will require a future Technical Corrections Act and regulations to answer. However, there's also a relatively short window of time to act. Therefore, action is critical. Second, much of what is going to be discussed today is general in nature, and you will each need to review, in light of your own economic and tax situation, the best course of action. There are both short and long-term implications to various decisions that may be made. These issues will need to be strategized with your key advisors and people knowledgeable in the law and your economic situation. Third, keep in mind that this law centers around economic survival and cash flow sustainability. Choices need to be made not only with current cash flow in mind, but with long-term viability. Will your employees still be here for you when you're ready to start back up in business? Will your facilities and suppliers be available to you? Have you and will you be in compliance with existing HR laws? It is our hope that this law will help everyone survive until normality returns. And with that in mind, let's move over to the meat of the presentation. And with that, I'm turning it over to Gina at Howard and Howard to follow up with her team and you. Thank you.
Thank you, Andy. This is Gina Stodiker. I appreciate that introduction, and those comments, Andy, were spot on with what we're seeing, and we very much appreciate being with you today. I'm joined today with three of my partners from Howard and Howard that have been working diligently in the background over the last several weeks as we anticipated some of this legislation, not necessarily all of it to come when it did. But I'm joined by two of our partners in our labor and employment group, as well as one of our partners from our tax group. And today, with our agenda, if you want to hop to our agenda, Matt, we are going to do our best to try to give you an overview of really the significant amount of legislation that came through in just the last 3 to 4 weeks, starting with an overview of the Families First Corona Response Act, and then also overlaying with that the legislation that was enacted on Friday, now commonly referred to as the CARES Act. So Emily and Dan are going to walk us through labor and employment considerations, and then Megan Parpart from our tax group will assist us in talking through those same pieces of legislation and highlighting some of the tax credits, and I say benefits, as it relates to how to manage some of the cash flow considerations associated with the leave provisions and some of the other very important loan provisions that came through both pieces of this legislation. Finally, we are going to bring a couple things to the attention of everybody on the call as it relates to other loans and other relief provisions that are out there. And as Andy mentioned, since so much has transpired over the last couple of weeks, we've done our best to pinpoint kind of the highlights today. Certainly each instance, the circumstances are very unique to each business. And so the best conversations are those when we can take those on with companies independently with them, as with their tax advisors and their CPAs, et cetera, to have a real robust conversation about that. So we're going to do our best to try to remove some anxiety around this tremendous amount of legislation and information that everybody's trying to digest in such a short period of time, and certainly open it up for questions at the end. So Dan, I will hand it over to you to take us through the labor and employment considerations. Thank you.
Well, thank you, Gina, and good afternoon. I am going to provide a brief overview of the Families First Coronavirus Response Act, the FFCRA. This is a new law that was passed and signed on March 18, 2020. And there are a number of provisions, but there are two in particular that apply to employers with respect to employee leaves. And there are two different leave laws. The first is the Emergency Family and Medical Leave Expansion Act. This is an amendment to the FMLA, and it adds a single type of leave, and that is to care for a child as a result of a school closure or loss of care. And the other leave law that was added was the Emergency Paid Sick Leave Act, which provides for emergency paid sick leave to employees for one of 6 reasons that are related to COVID-19. And I should mention that the expanded FMLA is also limited to a child care as a result of COVID-19. As I mentioned, the law was passed on signed into law on March 18th. Since that time, we have had some guidance from the Department of Labor. We are expecting formal regulations with respect to the new legislation. That is not out yet. However, the Department of Labor has been issuing responses to questions with respect to application of these leaves. So I will, throughout this presentation, or my portion of it, indicate where we have DOL guidance, but please bear in mind that DOL guidance is not law, it's not a statute, it's not a regulation, but it is a really good indication of what the DOL's position will be in an enforcement proceeding. So we definitely want to take note of that. On the slide I have in front of you, I've indicated that DOL has issued some guidance on the effective date of this act. It was not clear from the statute, but based on this guidance, we believe these new laws, or the DOL has indicated, these new laws apply to leaves effective on April 1, 2020, and only apply to leaves taken between April 1, 2020 and December 31st, 2020. Covered employers. You're all probably wondering whether or not you or your business are covered by these new laws. And the coverage for employers is essentially the same under both types of leave. All employers with 500 or fewer employees and public agencies are covered. And this is a little bit of a departure from traditional FMLA, which has a different requirement for employer coverage. And so even though some employers may not have been covered by the FMLA, it is important to note that they will be covered by this new expansion if the employer has fewer than 500 employees. As I mentioned earlier, we do expect to get a number of future regulations from the Secretary of Labor, but one thing that is of interest to many small employers is reference to future regulations exempting some employees. And we do have some guidance on that as well. There's a small business exemption for leave to care for a child's school closure or lost care only. And there are a few requirements to meet that. And basically, a business needs to certify that if it provides this type of leave, that it risks not being viable or there's a significant adverse impact to the business. So what is expanded FMLA leave for? As I mentioned, it is to care for an employee's son or daughter under 18 due to a child's school closure or loss of care related to COVID-19. DOL guidance has indicated that the small business exception would apply to this type of leave. And the expanded FMLA leave does not add any other type of leave, which is important for employers to note. But traditional FMLA does remain available. So if an employer is familiar with and covered by other FMLA leaves, that still remains in place. For example, there could be employees who have serious health conditions resulting from COVID-19, and they might qualify under traditional FMLA for leave. And all the same requirements will apply for those traditional leaves. How much expanded FMLA leave is available to employees? It is up to 12 weeks, very similar to FMLA leave. And when an employer looks at how much time is available, they can account for other leaves that have been taken under FMLA. I hope most of you or all of you are using a rolling method to determine the amount of time an employee has available for FMLA. So when you're looking at that 12-month period, you will count other leaves that have been taken for other FMLA reasons when determining the amount available for an expanded FMLA leave under this new law. The first 10 days of expanded FMLA is unpaid, very similar to traditional FMLA. However, an employer may elect to substitute paid time off to cover those 10 days. And as we'll talk about in a few minutes, emergency paid leave would also be available to those employers to cover the first 10 days of leave, so that an employee technically could cover the entire period of the expanded FMLA leave and have it paid. What is emergency paid sick leave for? So as I mentioned, this is a new law that adds paid sick leave for employees related to COVID-19 reasons, and there are 6 of them. The first one is an employee subject to a federal, state, or local quarantine or isolation order. The next one, someone who's advised by a healthcare provider to self-quarantine. The third one, experiencing symptoms of COVID-19 and seeking a medical diagnosis. And I want to pause here for a minute and point out that this does not require an employee to actually obtain a medical diagnosis or a note from a doctor confirming that the employee is positive with COVID-19. It's a much more relaxed standard, and it only requires that the employee contact the employer and say, I'm having symptoms and I'm following up with a medical diagnosis. A little later, we'll talk about some documentation issues and what an employer might be able to do in order to verify that the employee is in fact meeting those requirements. Reason number 4 would be caring for an individual under reason 1 or 2. Reason number 5, again, caring for a son or daughter due to the closure of school or lost childcare. This is similar to the expanded FMLA. And as I also mentioned before, the paid time off here could apply to that first 2 weeks of expanded FMLA to provide paid leave for those unpaid days. And again, the DOL guidance indicates that the small business exception would apply for this type of leave. And number 6 is a substantially similar condition specified by Secretary of Health and Human Services. Okay, how much emergency paid sick leave is available? For full-time employees, it's going to be a total of 80 hours. Some employees may work 50 hours per week. In that situation, they would still be capped at 80 hours. And if they needed 2 weeks, the employee would be entitled to say 50 hours the first week, 30 hours the second week, and then they will have exhausted the paid leave available. Part-time employers will look at the average hours worked over a 2-week period. If the employee has a varying schedule, or the employee does not have a work history, the employer can look at some other alternatives for calculating that by looking at the employee's work history over a 6-month period. And there are a few other variables that would apply there. An employer cannot require an employee to use existing PTO that the employer offers before allowing an employer to take emergency paid sick leave. Emergency paid sick leave does not carry over from 1 year to the next. It is a use it or lose it. And the emergency paid sick leave is not paid out upon a separation of employment. All right, calculating pay for expanded FMLA and emergency paid sick leave. So here the employer is going to look at the employee's rate of pay and pay the greater of regular rate of pay or applicable minimum wage. We do have some DOL guidance that indicates commissions, tips, and piece rates should be included in that regular rate of pay. And interestingly, the DOL has also indicated that you would also include overtime hours, but not overtime premiums in that calculation. The pay available for both types of leave will vary depending on the type of leave. Pay is 100% for reasons 1, 2, and 3 under the emergency paid sick leave from the prior slide. So anyone under a quarantine or isolation order from a government or a doctor, or anyone who has symptoms, would have full pay capped at $511 per day. If the employee takes paid sick leave for childcare due to school closure or loss of daycare, and the other reasons 5 and 6 in the prior slide, there's a cap. I'm sorry, the pay is only 2/3 of the employee's regular rate, capped at $200 a day, and the same for expanded FMLA, which makes sense because the leaves are similar among the two different laws. So there is a break for employers here, and the employee would not receive 100% pay under those circumstances. All right, which employees are eligible? So there is a length of service requirement for expanded FMLA, and it's 30 calendar days. You're going to look back at from the date the employee needs the leave for 30 days to see if the employee has been employed for that time. Interestingly, the Paid Sick Leave Act does not have a requirement that the employee be employed for any period of time. Employees are immediately eligible, which does make sense given the purpose of the leave, in order to allow employees to take time off to respond or deal with COVID-19 related issues. An employee must be unable to work or telework due to the reason for leave. And a note on telework: the DOL has indicated that a telework arrangement is something the employer can determine. So the employer will determine whether or not telework is a viable option for the employee. Both laws indicate that future regulations will be forthcoming regarding exempting healthcare providers and emergency responders. The DOL has issued some guidance. I am not going to go through the definitions of each of these, but I will put them up for you. And as you can see, for a healthcare provider, it is not only the healthcare facility, but really any business or employee that touches and supports the healthcare provider or facility can be exempt from these requirements. Emergency responder is equally broad. So really anyone related to providing emergency response can be excluded. Notice requirements. Under the expanded FMLA, similar to regular FMLA, an employee must provide as much notice as practicable when there's a foreseeable leave. If the employee is aware, once the employee becomes aware that they need the leave, they should contact the employer. For paid sick leave, after the first workday of paid sick time, then the employer will have employees follow reasonable notice procedures. I think the point of this is that employees may begin the leave immediately, let the employer know, and then the employer after that will implement normal procedures for the employee to follow. Documentation. There is nothing in the statute that addresses documentation. As you know, for those of you who work with FMLA leaves, there are specific certification requirements under the FMLA. So we do not have that yet. We may get that in the regulations, but we do have some guidance. And I've included on the slide the items that the DOL says that an employee should provide, but also that an employer must retain in their records. And it's pretty basic information: name, reason for leave, dates, source of quarantine or isolation order, documentation that the school has been closed or childcare has been lost. This is the employer notification to employees. This is on the Department of Labor's website. This notice must be posted by all covered employers as of April 1, so by tomorrow. If you are a covered employer, you need to get a copy of this if you haven't already and post it. Restoration rights. For those of you familiar with FMLA, you know that after an FMLA leave, an employer generally has to bring the employee back to the same or similar position. That is going to be the case for both expanded FMLA and emergency paid sick leave. There is an exception for employers with 25 or fewer employees. Basically, if economic conditions require or dictate that an employer cannot bring an employee back, and the employer makes an effort to stay in touch with the employee, then the employer can be excused from this requirement. Federal tax credits. This may be the most exciting part for employers with respect to these leaves. So although the employers who are covered must provide the leaves to qualified and eligible employees, the employer does get a credit, which is supposed to be dollar for dollar for each dollar the employer pays to the employee for these leaves. I think this will be covered a little later in this presentation, but I wanted to include a slide for reference so that you could see how these leaves or this tax credit might apply to the monies paid with respect to these leaves. Civil liability. It's important to keep in mind that failure to grant leaves or improperly denying leaves can result in potential legal claims. Under the expanded FMLA, I anticipate that an employee who is denied a leave that they believe they are entitled to could file an interference claim. There could also be retaliation claims if an employee wishes to allege that he or she has been retaliated against for using the leaves, the expanded FMLA leave. For the Paid Sick Leave Act, it is worth noting that the statute provides that the enforcement mechanism will be the same as the Fair Labor Standards Act, and this is very important for employers to keep in mind. Under the Fair Labor Standards Act, an employee is typically entitled to the wages that were not paid to the employee, plus an equal amount in liquidated damages, and the employer must pay the employee's attorney fees. So not only can this be expensive for a single employee plaintiff case, but many times we see class actions, And there's often little incentive for the employees to settle at less than they think they are owed, because they do have the amount owed is usually pretty clear if they are correct and successful in their claim. And also the employer's paying for the employee's attorney. So often the employee and the employee's attorney has not that much incentive to reach a quick settlement. Again, I wanted to point out that these leave provisions apply for to only leaves taken between April 1, 2020 and December 31, 2020 by employees. There has been a lot of discussion out there about employees who are laid off prior to April 1 versus employees who are laid off after April 1. Generally speaking, if an employee has been laid off and they are not providing service or working for the employer and they are not being paid, they are not employed in the eyes of the Department of Labor for these laws and will not be eligible. And that is going to be true if the employee is laid off before April 1 or after April 1. Once they are laid off, they are not going to be eligible, provided they are not working or being paid. So with that, I will turn this over to Emily, who's going to pick up and talk about employees in the workplace.
Thanks, Dan. So as Dan said, there are a couple of laws, right, providing leave for employees if they are still in your workplace. One of the things that we've seen employers struggling with over the past weeks, and we think will continue to be questions raised throughout April, relate to what is the status of your employees? Have they been terminated? Are they at home without pay? Have you had to put a stop work in place for a temporary period? Do you anticipate employees coming back to work? There are any number of scenarios we see employees in right now. And so as an employer, we wanted to remind the group of a couple things that you should be mindful of as you work through your employee status to avoid creating additional risks or potential liability in the more traditional labor and employment context. So the first thing to keep in mind is that in some states, when an employee is terminated, employers are required to pay out accrued but unused vacation or paid time off. When you have employees who are potentially on a less defined leave of absence, again, they're not being paid, they're at home, you perhaps have not taken formal steps to separate or terminate employment, where you're in this kind of vague status. We wanted to remind employers that you need to be mindful, at least in Illinois, where payout of that accrued PTO and vacation is required at the time of separation. Whether or not you need to pay out is very, very fact specific. It depends on what kind of communication has gone to the employee, what other triggering events may have happened, and what you foresee in terms of the employee's return. Is that period finite? Is it indefinite? But you need to be mindful of your requirement to pay out accrued leave to avoid the Illinois Department of Labor taking enforcement action. Other states have different requirements. Michigan's is much more policy dependent, so you just need to be looking at your policies and relevant state law to confirm whether or not you need to be paying out accrued leave. The second pitfall we've seen employers struggling with is kind of a no good deed goes unpunished. A number of employers are telling employees that even while they're on unpaid leave or not coming to work, the employer will maintain the employee on their health insurance plans or for benefits. That is a generous position, and we understand why employers are doing that. But we want to remind employers that you need to be checking with your plan or your policyholders and confirm with your carrier that it is acceptable to maintain employees who are not currently coming to work, who are not currently active employees on health insurance during that period of time. This is particularly important because a number of plans have what we call active service requirements. meaning in essence that someone is not an eligible employee unless they're actively reporting to work and working a minimum number of hours per week. If you keep someone on the plan who is not eligible under the terms of the plan because they're not currently coming to work, you run the risk of that person being not eligible and the insurance carrier denying coverage for medical care that the employees had to receive, which particularly in this environment, given the nature of the pandemic we're dealing with, creates certainly risk for employers and employees. So to the extent you're allowing people to stay on your plans, again, we understand why folks are doing that. We just want to remind you to check with either your broker, the plan documents, and your carrier to confirm that they're going to allow employees to stay on the plan during periods of furlough or temporary layoff. The third kind of pitfall to keep in mind relates to your exempt employees. Those are your employees who are paid on a salary basis. They're not eligible for overtime under the Fair Labor Standards Act. In order to maintain that status and not risk wage and hour claims in the future, you want to be mindful of cutting those exempt employees' pay or time as it relates to their pay. A key aspect of exempt employee status is that they're paid the same no matter how little or how much they work. So while we've seen employers who want to do, an across the board 20% reduction in salary, what you cannot do is tie any change in exempt employee status, salary to the amount of hours they're working. So you would not want to say you're only going to work 4 days a week and therefore your pay is going to be 80% of your regular salary. That ties the amount worked to salary, which creates problems down the road for maintaining their exempt status and avoiding, the overtime requirements under the FLSA. So if you are looking at situations where you're considering reducing pay, just make sure that you're talking to your counsel or keeping in mind the fact that for exempt employees, to protect that status, any reduction in pay cannot and should not be tied to the number of hours worked, and their salaries need to stay above the federal threshold, which right now is $684 a week or just over $35,000 annually. And aside to that, an exempt employee does not need to be paid for any week in which they do not perform any work at all. And so if that's the status of some of your exempt employees, you need to make sure that they are not accessing email, taking phone calls, even if only for a couple hours a week, because if they are in fact doing that, then you're looking at potentially owing them their full salary for the week in which they perform any work at all. The other thing we wanted to remind employers of, this is an unusual time, and we're very narrowly focused on how to deal with the COVID-19 situation and the impact on workplace. But we need to remember that the regular laws, right, the ones we're all used to following, still apply. As Dan noted earlier, the regular traditional FMLA qualifying reasons apply. If someone does develop serious health conditions, right, you're back into your normal employee protections and benefits related to medical conditions. The ADA, right, requires reasonable accommodations for employees who have certain medical conditions. And Title VII and your state civil rights laws continue to protect employees from discrimination. And so as you're making decisions over the coming weeks and months, whether they relate to who's being sent home, who's being placed on unpaid leave, and as businesses begin to ramp back up and you think about order of bringing employees back and who you're going to bring back and who may not come back to work, you need to be mindful of basing those decisions on objective criteria or criteria that you could point to if questioned to avoid any appearance of discrimination or risk of a discrimination claim. And again, we wanted to flag some of these issues so that as we all are so focused narrowly on the COVID-19 issues, we don't, forget and inadvertently create additional risk for businesses in these very unusual times. So we have a couple of slides on what employers might do when they have someone exposed to COVID-19 in the workplace. And I want to go ahead and get on to the tax portion of the presentation, but just as a quick overview, the most important thing is for employers to keep in mind that employees who have disclosed to you that they have either tested positive or are being tested have, their medical privacy rights continue to apply in the workplace and confidentiality. So while you certainly want to take steps to investigate who they had contact with and where they were and provide appropriate notice to coworkers who might need to be quarantined, you need to be very mindful to do that in a confidential fashion and not disclose the name or health information of the particular employee you're dealing with. So with that, I will turn it over to Megan and Gina to dive into the CARES Act and some of the benefits out there for employers.
Great, thank you, Emily. Go
Um,
ahead, Megan.
I'm just getting my screen up here. Okay. So, just to kind of clarify something here, because we understand that our audience who's been busy running their businesses maybe are not following the legislation as closely as we are. So there's been thus far 3 coronavirus quote relief or stimulus acts. The first one probably we all missed. It was more targeted towards testing and treatments. The second one, which Dan and Emily just spent most of their time talking about, was the Families First Coronavirus Response Act. That is the act that both mandated the expanded FEMLA and emergencies sick leave and provided the corresponding tax credit. And then the one that everybody's talking about right now is the quote CARES Act. And that's where most of my time will be focused on. And we just wanted to note that there's already talk of phase 4, so stay tuned. So in talking about the CARES Act, which I'm sure everyone heard lots about it over the weekend. So the focus of this act was really on employers and employees who have been heavily impacted by this virus. So I'm sure you heard about the relief payments to individuals and the expanded eligibility for unemployment benefits, and we're going to get into all that. But first, we're going to talk about the very popular Paycheck Protection Program. So the Paycheck Protection Program is the expanded SBA loan program. So the goal of this is to incentivize businesses that laid off or are considering laying off or reducing the pay of their employees to get those people back on their payroll. So this program permits the employer to borrow 2.5 times their average monthly payroll costs, or $10 million, whichever one is less. So the 2.5 times average monthly payroll, that's a little bit fluid. This is one of the areas where we need guidance. The way it's written now, it's a trailing 12 months up until the date the loan is funded. Obviously, that's difficult to calculate because when you apply for the loan, you don't know the date it's going to be funded, so the result could be different. So that's one of the areas where a little bit of clarification is needed, but generally it's your average monthly payroll for 12 months. And there are special rules for seasonal employers. In order to get this loan, 500 or fewer employees, there's some exceptions for certain industries, or if you can meet the SBA size standards, you can also qualify, and you have to have been operational as of February 15th of this year. So the big incentive part of this loan, so I should clarify, the loan is available for anyone. Whether or not you want to pursue loan forgiveness or not is separate. You can still get the loan, and the loan terms are very favorable. We'll cover those on a later slide. And you can just repay the loan like any quote normal loan that you would get. But there's also the ability to have a portion of the loan forgiven. So the portion that can be forgiven is the portion that you use for the 8-week period from the day you get the money. So it's 2 months essentially, hence the number 2.5 times your monthly payroll. So you can, the portions to be forgiven, you can use to pay for very specific things. Quote, payroll costs, which is a defined term, broadly defined to include payments to independent contractors, as well as healthcare costs, mortgage interest, utilities, and rent. So only the amounts used to pay for those specific items are going to be forgivable. And if you have a reduction in force or a reduction in compensation of your employees more than 25%, then the amount that can be forgiven is reduced. So it's not an all or nothing. You can still lay people off and get a portion of your loan proceeds forgiven, but it's a percentage reduction. And the portion you can get forgiven will also be reduced. So this does apply to all, so both the amount you can borrow and the amount that can be forgiven applies to all your employees. But to the extent you have employees making over $100,000 annually, both the amount that can be borrowed and the amount that can be forgiven only includes the first $100,000 of their salary prorated for the applicable period. So they're not excluded, it's just capped at $100,000. So if you already have done layoffs, which I'm sure many business owners have, you have 30 days from the date that the law was enacted, which was Friday, to rehire those people without getting a reduction in the amount that can be forgiven. So the loan forgiveness is not taxable. So it will not be included in gross income or taxable income. And you can combine this with the disaster loan. So a lot of people, the disaster loans have already been live for almost a week now. A lot of people have already done those applications, and guidance suggests that you might not have an application for Paycheck Protection loans till at least the end of this week, and maybe mid to late next week. So if you already have a disaster loan in place, you can proceed with that, with getting that loan. But the amounts that the loans cover cannot be duplicative. Therefore, if your only expense is payroll, then you cannot take a disaster loan and a Paycheck Protection loan to cover only your payroll. But to the extent that you have expenses outside of those very specific things that Paycheck Protection can be forgiven, so the mortgage interest, utilities, rent, and payroll costs, then the disaster loan can supplement that. So for example, if you have materials costs, or you have other costs that you need to spend in order to keep people working because you want to bring them back, then the disaster loan could come in to supplement that. And here, this slide talks about the disaster loan program. This program is live, sba.gov/disaster loan. And you can go on there and apply now. It's the kind of regular SBA application. So there's a loan application, personal financial statement, statement regarding your debts of your business. And I think I saw a question in there regarding, can you apply for every company that you own? Yes. Each entity can apply on its own behalf. So if you're interested in pursuing the Paycheck Protection Program, obviously we would first encourage you to reach out to your legal and tax advisors to confirm that you qualify. Like we said at the beginning of the presentation, this is very new. There's very little guidance, and this statute was written very quickly, meaning there's a lot of holes, poor drafting, even potentially drafting errors. So first, you want to reach out to your advisors to make sure that you qualify, and they can point out, any uncertainties in the legislation that, you should be aware of before you go forward with it. The next step would be to reach out to your bank and ask them if they plan to participate. Most banks we've talked to are participating, but maybe some of the smaller local banks might not be. And then you're going to want to start gathering your information. And I wanted to make sure I point this out. So the payroll protection loan specifically, in addition to the quote traditional information you would need to obtain a loan, such as tax returns and financial statements, you're going to need payroll information. You're going to need your quarterly payroll returns for 2019, as well as the entire 2019 payroll records. For a lot of, especially smaller businesses who outsource their payroll, these accounting firms who do your payroll or these payroll companies, they might be getting bombarded with these requests right now. And while banks are going to be in a position to ramp up very quickly to meet this need, those payroll companies may not be. So I would very much encourage you to reach out to them as soon as possible and get those requests for those documents in, because that is something that the bank is definitely going to require, because it directly relates to how much you can borrow. Okay, so some other highlights of the CARES Act. The employee retention tax credit. So this is going to apply to only those wages that you're not getting forgiven under Paycheck Protection Program. So one thing to note about Paycheck Protection is it is only for 8 weeks. Maybe it will get extended in a later bill, maybe it won't. So there's a number of businesses where 8 weeks of payroll is not going to be enough to help them recuperate from the hit that they're going to take from this pandemic. So here's some ongoing tax credits. So the employee retention credit is a tax credit for 50% of the qualified wages paid. It's capped at the lesser of either $10,000 per employee or the total amount of Social Security payroll taxes you owe for all your employees per quarter. So if you have less than 100 employees, it will apply to all your employees. If you have greater than 100 employees, it's going to apply only to the wages you pay to employees that are not performing services. Again, this is not available for amounts that will be forgiven under Paycheck Protection. And so the qualifications for this are you have to be either fully or partially closed due to COVID-19 or a related governmental order, or have a significant decline in gross receipts. So the way that's going to be measured is your gross receipts are 50% or less of what they were in the same quarter in a previous year. And this is going to apply for wages paid after March 12th and before the end of the year. So another benefit, this was one that was much talked about before the act passed, the quote payroll tax holiday. And this is a deferral of the Social Security portion of the employer's payroll taxes for the rest of this year. Half of them are going to come due at the end of 2021, and the other half are going to come due at the end of 2022. And some other highlights of the CARES Act, we talked about the retention credit, the payroll tax credit. Net operating loss modification relaxes some of the limits on the use of NOLs that were enacted as part of the Tax Cuts and Jobs Act in 2017. And any NOL generated in 18, 19, or 20 can now be carried back 5 years. So if you, to the extent you have losses this year or one of the 2 previous years, you can look at carrying those back 5 years. That's going to be very lucrative for the corporate taxpayer who was being taxed at 35% in those years. So that's going to be amount to a very valuable credit, as well as there's an accelerated use of AMT credits that were accrued prior to the enactment of tax reform. Here's a few other, we're getting into the more technical tax aspects. So these are more of the specific questions you would want to talk to your advisor about. Unemployment guidance. So I'm sure you heard that the CARES Act expanded unemployment benefits to $600 a week in addition to what the state already offers. So in Michigan, the maximum you can get under unemployment is $382 a week. So if you're maxing out, you're getting $982 per week in unemployment benefits. The additional $600 from the federal government is for 13 weeks, but Michigan has expanded to offer unemployment benefits for 39 weeks. So if you're contemplating layoffs, it is important to consider what the employees could get if they were on unemployment. So these are greatly expanded benefits that could be very beneficial to a lot of employees. Additionally, the CARES Act encourage states to adopt the federal law that expands the availability for unemployment. So it expands it to people who are employed part-time, self-employed, and some other expansions. So Michigan was actually, I read last night that it was only Michigan and Florida. I don't know if other governors have adopted it as of today, but you can go online to michiganbusiness.gov and read the executive order from Governor Whitmer regarding the expansion of the unemployment benefits to those, quote, non-traditional employees or people who maybe aren't even considered employees. So there's a comment on that: self-employed, independent contractors, etc. So like Dan and Emily echoed, regular laws still apply. So unemployment does not apply to people who are teleworking or receiving paid benefits. Unemployment does not apply to people who are voluntarily unemployed. So if employees are saying that they just don't want to come to work because they would rather get unemployment benefits, that's not a reason to go on unemployment. You have to be terminated from your job, not by your employer, not voluntarily. But they have relaxed the requirement that you be actively seeking work. Most states have relaxed that requirement so that you don't have to actively seek work in order to qualify for those benefits. So I'm going to turn it over to Gina now, who's going to talk about some of the other tax benefits under Families First Coronavirus Relief Act and others. Gina?
Thank you very much, Megan. I might need someone else to run the screen here because I don't know if you can see my screen.
Yeah, I can.
Very good.
Okay.
So as Dan alluded to earlier on, along with the mandates that came through the Families First Coronavirus Response Act, there were credits that were corresponding with that I think we covered in terms of the caps that would be covered for payments made, essentially allowing, I think we can go ahead and flip through this part quickly, Megan, essentially allowing, as it relates to the paid sick leave, a cap of up to $5,010 per employee, capped at the 80 hours that Dan covered earlier, as on a per employee basis. So this provision essentially allows the employer to recoup via the remittance, the retention of payroll tax withholding. In lieu of paying that, they can essentially retain the withholding as a means for making those payments. So from the employer's perspective, there is some recovery here for these enhanced paid sick leave provisions. Thinking about, and the same is true as it relates to the expanded family medical leave provisions there. There is a cap of up to $10,000 per employee for expanded family medical leave that can also be used via the retention of payroll tax withholding in lieu of remitting. To the extent that you have remitted or you do remit, it is in those instances that you're able to seek quick refunds. And that brings us to some of the items that Megan and I have been focusing on as it relates to quick refunds and the ability to use withholding taxes. Well, here's an example, the IRS guidance examples. These were given to us from the IRS, but this is a good example demonstrating to the extent that you have accrued withholding, that the amount that you have on deposit, that you can use those amounts for paying your required paid sick leaves and or expanded Family Medical Leave Act payments. And similarly, to the extent that you do not have enough in terms of your on deposit, that's the portion for which you would seek a quick refund, which the IRS has indicated that they will be processing those within 2 weeks. We haven't heard how they're going to do that, but that's the word that we have in terms of their timeliness to respond to those. The idea of getting money back into our businesses. So I think thinking about quick refunds and credits, there's some confusion there, but the idea here the spirit of the legislation, both in the Families First Corona Response Act as well as in the CARES Act, is clearly to look for ways in which business owners can retain and or go back and identify taxes paid or taxes that don't need to be paid. And with that, states have been following alongside with the with what we see out of these federal this new legislation at the federal level. So with that, what came out, I guess it was last week or even the beginning of the previous week, the postponement in terms of filing of income taxes. What was our April 15th tax day at the federal level has essentially been moved to July 15th for all practical purposes, and that includes both the filing as well as the payment of taxes. Note that for purposes of managing your own tax environment, your own tax position, that the due date for second quarter estimated tax payments will still be due on June 15th. I haven't seen anything changing in that realm. So just be prepared in terms of, again, from a cash flow perspective, that there will be tax payments due both in June and July. Again, keep an eye out here. You can see here the IRS is committed to providing these refunds actually within 21 days. And the source there is the IRS website. I was going to say, similarly, Michigan is following along with the federals as it relates to the delay or the deferral and postponement of when both returns need to be filed as when the payments need to be made. As you can see here, that the executive order here extends the time in which those payments must be made. I think the other piece here as it relates to state or city income taxes, I think that one surprised me a bit, the executive order that essentially mandated the extension of state and city income taxes that would not necessarily need to be paid until July 15th, and that those balances would not be due for any unpaid balances until July 31st. As it relates to other state filing and relief and support, we are spending a great deal of time working with businesses at this point as it relates to both assisting on the SBA loan as it relates to the economic disaster loans as well as the new paycheck protection. But corresponding with those, the states and even some of the local municipalities have come up with some pretty clever short-term loan and grant relief programs. If you want to go back real quick, Megan, I think your point there as it relates to the change in lifestyle that many of us have had to adapt to in terms of working from home, in terms of, for example, here, if you were otherwise employed in the city of Detroit, you have now spent the last several weeks working from a non-city of Detroit location. These would be taxes that you would no longer owe in the city of Detroit. So keeping that in mind in terms of other city jurisdictions where you may have employees and or yourself in terms of where you're domiciled and where you're working. But getting back to the relief and other support provisions as it relates to from a cash flow perspective, here's where we've been spending a great deal of time trying to complement the efforts on the SBA side as well as some of the more business credit provisions. There are a number of both grant and loan programs. The Michigan Small Business Relief Program, while it was a little bumpy getting up and running, we have been successful just in the last 2 days in submitting applications to the MEDC, the Michigan Economic Development Corporation, as well as to some of the local supporting economic development offices. I highly recommend that you look at the michiganbiz.org website. Some of the applications are not open. We're happy to take calls and assist you in trying to identify whether a grant or a loan program is best for your situation. The grants at the Michigan state level are limited to $10,000 per entity. The loans are up to $200,000, but those funds are very limited. But as you can see, the interest rate on the loan is at 0.25%. Those are loans for companies with 50 or fewer employees. And the grants can help for basically payroll or working capital. And let's see here, and those are limited to $10,000 per entity. So 200,000 at the loan level, 10,000 at the grant level. One of the items here, I saw some questions coming through as it relates to the ability to use both programs. So I think the question was asking whether you can utilize, if you've applied for the economic injury disaster loan, can you also apply? Megan touched on that, but correspondingly with regard to some of these state fundings, they do ask the question if you have applied or if you have obtained financing through other sources. And our recommendation has been there to continue to apply and be transparent about the fact that you are seeking funding from these other sources, but have yet to receive. We have found that the availability of some of these programs is still there if the timing by which those funds could not be available to meet your business emergency needs. Going to Chicago, similarly, there are a couple of unique programs there. There's a hospitality emergency grant program that, again, these are for businesses of essentially less than $10 million. These are grants, however, as it relates to 10 to 50,000, depending on the size of the business. Similarly, the Illinois Small Business Emergency Loan Fund. These are very low interest rates with forgivable features as well. Again, these are for small businesses with workers, 50 workers or fewer. The Downstate Small Business Stabilization Program operates very similar as to the Illinois program, the statewide program. Again, these are grants capped at $25,000 for businesses with 50 or fewer employees. And then the private fund, this resiliency fund, was basically comprised of several private funders that pooled over $100 million in funds for low interest loans. Interestingly, in many of these programs, even nearly pre-revenue businesses are allowed to apply for some of these. So companies with less than 2 years of operating are eligible for many of these grant and loan assistance programs. So that brings us to the end of our kind of prescribed materials. I know we have a number of questions out there, and of course I would be remiss not to mention that of course everything that we've shared with you here today of course is guidance and educational in its nature. To the extent that you are seeking legal or tax advice, we encourage you to reach out to your tax and legal advisors, or of course you can reach out to any one of us. There is a question as it relates to copy of the slides. I believe the slides are going to be, or the session has been recorded, and we're happy to share information with, in accordance with Andy and Matt, how you would prefer that we handle that.
Yeah, so first thing, thank you to Emily, Dan, Megan, and Gina. All really great and timely information. Yes, we are recording the session. It will be on our website, as well as we'll be emailing out a recording to everyone who had registered. So yes, you will get a recording. If you want the actual slides, you can reply to the email that you received with the recording and just kind of indicate that you'd like a copy of the slides as well. And we'd be happy to share those with you as well. We have a few questions that have come in. I know the attorneys at Howard & Howard have been trying to answer a lot of them on the fly. So if you go to the Q&A box, there's 13 answered questions already, but we're gonna kind of try to get through a few more right now. We'll go for like another 15 minutes and then jump off. So first question, and feel free, anyone who wants to jump in. I'm receiving conflicting info on the period we use to calculate the average weekly wage for non-seasonal employers in business all of 2019. Is it A, calendar year 2019, B, 2/15 to 6/30/2019, or C, 1 year prior to loan origination? So perhaps 4/1/19 to 4/1/20.
So that's a good question. And so if you're talking about the amount you can borrow, 2.5 times your average monthly payroll, the way it's written now is the 12 months prior to loan origination. That's difficult to determine because generally the date of origination of a loan is at the date you get the funds, which of course could change the answer. So your bank may have other guidance or a different formula they're using because there is a little bit of a lack of clarity. But if you're talking about how much you can borrow, you're talking about the 12 months prior to the date of origination. If you're talking about how much you can have forgiven, it's the actual amounts you spent during the 8 weeks from the day you receive the funds. So hopefully that answers that question.
Megan, the only thing I was curious in that question was if they were thinking about the different timeline for seasonal employees, but that would be the only other modification to that answer that you just gave as it relates to seasonal employees look to a different timeline in determining their average monthly wage base.
Yes, if you're seasonal, you're looking for the same period of 2019. So it can you at your election, it can be 2/15/19 to 6/30/19 or 3/1/19 to 6/30/19. That's for the amount you can borrow.
All right, sorry, next question, and I apologize if you hear my daughter in the background. How do you handle the situation where the essential business owner is intending to apply for a PPP loan and is keeping all staff at 100%, but there is an EE who wants to file for unemployment because of need to take care of a child due to school closure, or in another situation where the EE does not want to be potentially exposed to the virus, so considering unemployment? Will the business owner be penalized for the EE who goes on unemployment? And what are the logistics for paying the EE's wages while on leave? Does the ER pay the EE and then get reimbursed from the government?
So that was there's a lot of parts of that question, and I'll answer part of it, and then I'm going to kick it over to Dan and Emily. So if you have a reduction in workforce, the amount you can have forgiven under Paycheck Protection is reduced. It doesn't matter if they quit voluntarily or you terminate them. Either way, it's a reduction in workforce. If they're on paid leave, they are still your employee. So that's not a reduction in your workforce. But if you get a credit under Families First Coronavirus Relief Act because they're taking one of those expanded leaves, you cannot also have amounts forgiven under Paycheck Protection for those same amounts. So it's one or the other. There's no double dipping. And then Dan and Emily can explain, because we're getting this question a lot. I have all these employees who don't want to work because they're afraid of getting the virus, or they would just rather be on unemployment because the unemployment benefits are so generous now. So I'm going to kick that over to them to explain the answer to that question.
So if I understood the question correctly, and Dan, jump in if you disagree or have a different understanding, it sounds like these employees are still being paid by the employer, though they are not currently at work. Is that accurate?
That's what it sounded like, yes.
Yeah, so I don't believe they would qualify, and we are not unemployment attorneys per se. I don't know how they would qualify for unemployment if they're still receiving pay from the employer. Usually when someone applies for unemployment, the employer receives an opportunity to, provide facts in response to the unemployment filing and to fill out forms showing how much income that employee has had. So my belief is that would interfere with the employee's ability to receive any funds under the unemployment program. I do not believe that the employer would receive any kind of reimbursement for wages paid. If someone, to Megan's point, it sounds like there's two other kind of situations. One is if an employee is saying, I can't work because of a childcare issue, and the employer has work available for them, then you're under the expanded FMLA and the emergency Sick Leave Act, where they would receive 2/3 of pay and the employer could get tax credits for the amount paid out under either of those programs. Third, as Megan said, if there's an employee where there is work available and the employee is just saying, I don't want to come to work, that generally speaking would not entitle the employee to unemployment benefits because there's work available for that employee.
I agree with that, Emily. And on that last point, there may be some issues with employees claiming they can't get to work or unable to work due to COVID-19 related reasons. And there is some expanded coverage for that referenced in the CARES Act that was passed last Friday, or signed into law last Friday. So I think employers should take a little extra care in looking at that situation where an employee says, I can't come and I can't work because of a COVID-19 related reason. And just think about it, or maybe consult with their legal counsel, determine how to handle that employee. But I agree, if there's work available and the employee just doesn't want to come in because they're afraid of contracting COVID-19, I don't think they would generally qualify for unemployment.
All right, another question. Do all SBA affiliation 500 employees rules apply to the PPP, or there going to be exceptions? Or are there going to be exceptions?
I'm happy to respond to that. There are the SBA rules for employers with 500 or fewer have been expanded, and we are expecting some additional guidance as it relates to what those expansion numbers in terms of your employee count will look like. So it has been expanded. It depends on the industry as well, in terms of whether it's 500 or fewer, in terms of the applicability of the loan program. And one of the items that we find interesting is that to the extent that you are an NAICS, basically SIC code, in the hospitality or accommodation industry, for example, you could have multiple locations with 500 or fewer employees, but in combination have more than 500 employees, but on a per location basis, you would qualify under the small business loan program, under the Paycheck Protection Program, on a per location basis. So part of it depends on the business and what expansion definition you might fall under.
Great. Does the PPP plan work for companies less than a year old?
Yes, it's in operation as of February 15th of 2020.
The business had to be in operation, yeah, as of February 15th of this year, yes.
If I request employees to return to work, but they decline because of the amount they are receiving in unemployment, will they still receive the unemployment money?
Well, I think that is one of the issues we were touching on a few minutes ago. If you have work available and the employee does not come to work, it seems that they would not be eligible for unemployment. But again, you may need to explore that a little more to determine whether or not it is a COVID-19 related reason. But as a general matter, an employee who refuses to come to work is essentially a no-call, no-show, or probably violating other policies the employer has in place. So the employer should look at their existing policies as well to determine how to handle the employee. I don't know, Emily, do you have anything more on that?
No, I think generally if there's work available and they're declining, that for the most part operates as either, a voluntary resignation from the unemployment perspective. And Dan's right, you should follow your normal policies. But my understanding of unemployment is generally if there's work available for you, you're generally not eligible.
All right, another question. I may not have heard this correctly, but did someone say payroll costs under PPP include independent contractors? If so, Is the quarterly payroll information supposed to provide for those individuals?
Yes, it does include independent contractors, provided that they're an individual or someone who would otherwise be your employee. So if you 1099, Howard and Howard for legal fees, that's not going to count. But if you 1099 someone who's providing services similar to what an employee would provide, then that will count. And that would not be reflected in your quarterly payroll report traditionally. And so the information request I got specifically said, please provide all 1099 payments, but exclude those, for services.
To jump in real quick, Matt, just to be clear, independent contractors, however, do not count for the 500 employee threshold for the expanded FMLA and sick leave. I just want to make that distinction.
And to Emily's point, they also do not count for the number of employees you have and qualify. So if you have 500 W-2 employees and 20 independent contractors, you can still qualify for the PPP and count the amounts that you pay those independent contractors.
Okay, another one. Do owners of S corporations that are paid as W-2 employees qualify to pay their payroll using PPP loan funds or are their payroll costs allowed to be included in the loan forgiveness amount?
Yes to both of those, as long as they make $100,000 or less. And if they make more than $100,000, then the amount they make over $100,000 is excluded, both from the amount you can borrow and the amount you can have forgiven.
There was a question, Matt, I don't see it now as it relates to the carryback. So the question was a 2008 NOL, could that be carried back? And I was trying to answer that. The answer to that is yes. So essentially they could look back 5 years to do carryback. So the idea would be to go back to prior years and get some additional cash refunds, which the IRS is committed to filing and processing those refunds quickly.
So I've seen kind of two similar questions also. If I get a loan relief, I must continue my payroll in addition to using for rent and business overhead, not send employees to unemployment and use loan for other overhead. And then also, once you pass the 8-week forgiveness period, can you use the remaining loan proceeds to pay down, for example, an existing line of credit or pay general overhead?
So the loan proceeds can be used, there's a long list of things. It's all the traditional things you can use an SBA loan for, plus the payroll costs, mortgage interest, rent, and utilities. The amount that can be forgiven is only the payroll costs of mortgage interest, rent, and utilities. So it's not general overhead. It's just those 4 specific things. But the rest of the proceeds and after the 8 weeks, yes. But if you want to lay everyone off and get the loan proceeds, you can do that, but you cannot have anything forgiven if all your employees are laid off.
A few more. There are provisions on the Michigan SBA loan relating to showing loss of income. Is there a similar provision on the federal loans?
There isn't a, go ahead, Megan. I guess what I was just going to say there's a general requirement of economic injury, which can be shown in terms of your loss of revenue. But go ahead, Megan.
Yeah, I was going to say that that, along with any of the kind of other traditional requirements, have been relaxed through the CARES Act. There's a presumption that you've been impacted by COVID-19. You do have to sign a certification that you've been impacted, but there's not going to be a lot of documentation that you have to provide to show the economic impact.
If a senior citizen does not file income taxes due to low income, is she qualified to receive the $1,200 relief fund if her annual income is very low?
Unless, Gina, do you know?
I honestly don't know the answer to that question.
I have not, if you go to irs.gov, there's a huge banner that says the individual relief payments do not call us, but there's a link you can click that has some information, and it might be there, but I generally focus on business tax, so I haven't looked at the individual provisions, so I don't know.
I think I read somewhere today that actually there is information on the IRS website and a form you can fill out for that exact situation, and you are entitled to a payment.
We'll go to the top until 2 o'clock. So if we got 5 more minutes. If you've laid off your employees, can you wait to get the loan and then bring the employees back?
As long as you get the loan within 30 days from Friday, yes. But you only have 30 days to bring them back. Now, if you bring them back later than that, you just don't get as much forgiven.
As far as the CARE Act goes, if you let go of your part-time employees and keep your full-time employees, are you still eligible to apply?
Yes, it's full-time equivalent employees during the 8-week period. And there's a comparison period, a couple different ones you can elect. But it is, for both cases, it's full-time equivalent. So yes, you can let go of your part-time employees.
Does participation in state loan program impact federal CARES application?
Not really. It might impact disaster loan application, but it won't impact PPP.
If we are operating in New York and already have a state mandated paid family sick leave coverage, who should we look to first for coverage if needed? CARES or our existing policy?
I think, is that a reference? I think that's a reference to the emergency paid sick leave under the Families First Act. And the DOL guidance, I believe, says that goes first above all other, above and before all other paid leave programs.
The emergency paid sick leave, Emily?
Yeah, the new federal bucket goes first.
Yeah, I agree. And I think the language also indicates, or the guidance indicates, that if an employee wants to take that leave, an employer could not require them to substitute other leave first.
Is there any advice on asking your insurance company about making a claim against lost?
Was that a reference to, I didn't see the question, is that a reference to like business interruption?
Yes.
I'm not sure I heard the whole question, Matt.
Sorry, my dog's barking in the background. Is there any advice on asking your insurance company about making?
Yeah, you cut out again. So if you're talking about business interruption insurance, I don't have any advice. I don't know if anyone else deals in that area.
I think that some states have taken action, and I'm an employment attorney. I don't know if anyone else has thoughts. I believe some states have taken action. There's already been some litigation about what falls under the business interruption provisions, and some states have taken, I believe, some action about how insurers can deny or provide coverage. In terms of asking the insurance company about making a claim, I guess I would suggest that you have an attorney or someone review your provisions before you go directly to your insurance company to make sure that you're not saying anything in that inquiry that would prejudice your rights later on to make a more formal claim. But there are usually notice periods, so you might want to make sure that you're moving efficiently.
We should clarify, at Howard and Howard, we do have those resources. They're just not any of the 4 of us who are on this webinar. So you can reach out to one of us and we can connect you with someone who can help you if you do need assistance.
All right, I think we'll close it off there. If anyone has any additional questions that was not answered, you can direct them to myself at telemus@telemus.com, and we will try to answer them as timely as possible. Again, there will be a recording that will be sent out to everyone shortly. And I just want to give a big thank you again to the folks at Howard & Howard